Hello and welcome to Building the Premier Accounting Firm. I'm your host, Roger Knecht, President of Universal Accounting Center, and it's my pleasure to have each and every week a guest on the show to focus on things that we can be doing to offer quality accounting services and become the premier accounting firm in our area. As we do this, each and every week we have on experts to help us focus on things ranging from marketing, selling, pricing, tech stacks, training our staff, offering quality services to our clients, onboarding them, retaining them, even as much as mental health. And today's going to be a wonderful discussion as well. Today, we're going to begin with the end in mind, discussing exit strategies, things that we can be doing to actually work on our business and as well as accounting professionals work with our clients. My guest is Nancy Mills. She is a sought-after speaker who brings energy, expertise, and real-world insights to business owners. She works with executives, entrepreneurs, business owners just like us. Now, with a proven track record in optimizing companies for investment, expansion, and successful exits, Nancy delivers powerful, actionable strategies that drive real results. Whether on stage or in a boardroom or on the air, she captivates audiences with her engaging storytelling and broad knowledge. Nancy, welcome to the show.
Thank you, Roger. It's so great to be here.
This is going to be a lot of fun. You know, exit planning is one of the topics I thoroughly enjoy discussing. You have to begin with the end in mind. And with that being said, we're all building our businesses, but more importantly, as accounting professionals, we work with owners of companies who likewise have companies of their own. And I think very often it's very customary for the accounting professional to be asked questions about what's my company worth? You know, what can I get? I've got shareholder issues I need to discuss. These things come up regularly. So what I want to do is begin with you by asking, what is it that business owners fail to realize when you talk about their exit planning? Oftentimes, it's just not on the top of their mind. Wouldn't you agree?
Completely agree, Roger. They don't understand. They think that exit planning means you're putting my company on the market for sale right away. Mm-hmm. That is a common perception even with people in the M&A industry.
Yeah, one of the things that I think is interesting is when I have conversations about exit strategy, it's either it's so far off in the future, it's nothing I'm worried about, so it's years away and why worry about it? Or it's more importantly, I'm never going to sell. I don't have any intentions of changing. But the reality of it is life happens. And whether it be circumstances such as divorce or health or just things happening in the business, you have to always have your business ready to sell. Why? It's just like your house. You've got to keep it well maintained. Wouldn't you agree?
Exactly right. Yes.
Yeah. So when we're talking about this, why should business owners actually care about the transition planning? I mean, this is something that they may not prioritize, like their marketing, like the growing of the business, the top line revenue. Why does this matter?
Well, I want to first affirm what you said, that they don't think about it until it's usually too late.
Correct.
And the reason that I found is because people they think it means they're no longer necessary, that they're not wanted, or they're on the path to death. So the topic feels taboo for business to think about. So that's a barrier that I'm glad for the opportunity to talk to you to help spread the word. Why is it important? There are a number of reasons, but one I like to talk about is, you were mentioning divorce and disease. We call them the dismal Ds.
Yes.
Divorce, disease, death, there's disagreement with your business partner, and there's disability. And all of these things can happen suddenly and out of the blue. And so if the exit plan isn't already in place and certain documents aren't executed, then the business is in real danger of suddenly failing, and the families of the business owners and the employees and actually the community will suffer because the company will drop in value and can end up folding.
You know, we're recording this right around Memorial Day, and coincidentally, I was at the funeral, at the graveside. We were reminiscing over family, and it came up again that there are some people, myself not included, who have gone to the extent of actually doing their planning as to what is their burial going to be. You know, have they bought the plot? Have they perhaps purchased the casket? And there are plans out there for this that you can prepay so as to not burden your family with these things at the time of your demise. And I think it's just very smart to take into considering these types of things. On a more optimistic note, you have situations like your children growing up and getting married, moving out of the house. Well, you'd like to think that they're actually capable and competent of living independently and contributing to a relationship, that they're healthy in the sense of their mindset and their emotional set. Well, that's no different than a business. One of the things that I always talk about is you need to, with your business, build a business like a child, having it be a self-sustaining living entity that can live independent of you, helping that business move from that childlike state to a teenage state to an adult state where it can hopefully operate in your absence. So as we're going through this transition period with our business, are there phases that a business owner may experience as they're transitioning?
That's a great question. And I also love your metaphor about the treat it like a child and let it
Mhm.
grow and thrive on its own. I'm going to borrow that in the future. So phases, when you say phases, you mean of the actual transition plan itself?
Yes. So when a business owner looks at that daunting thing of I'm going to step outside of the business, I'm no longer going to be maybe the owner as involved in the day to day as I am. What does that transition in your mind look like? What are the stages of that?
Such a great question. The stages would be, first of all, admitting and acknowledging that you won't live forever and you won't want to work forever.
Yeah.
Because most people, and that's what I love about being alive today, is we're so healthy, we're so vibrant. It's so great to be alive, and people get a lot of meaning and joy out of their work and also community. So that's great. If the business owner wants to come in and work until they drop, they still need an exit plan. If the business owner knows their kids are taking over, they still need an exit plan. So the phases would be first acknowledging that you need an exit plan. And really having the first conversation with the trusted advisor is often the most difficult because of that mental hurdle that we talked about earlier. So just be brave, talk to your trusted advisor if it's an accountant or a lawyer, but don't stop there. So the next step I would say is to begin to think about who your advisor team would be. And that would include ideally a certified exit planner who understands all of the nuances of this area, your estate planner, your wealth planner, your business lawyer, who might not be your ideal lawyer through the transaction. Just keep that in mind. But start to assemble your trusted advisors and get to know who your team will be, because together they will set the business owner up for success. That would be, of course, the accountants.
I like that you brought in the team because as accounting professionals, we'd like to think that we're part of that team for our clients. And that team that you're describing, we play a role in that. There's something
Exactly.
specific that accounting professionals can bring to the table. First and foremost are timely and accurate financials, because clearly
Yes.
a business that has 3 years of good, clean financial numbers is much more marketable than a business that doesn't have clean accounting numbers. Wouldn't you agree?
Oh, completely. That's preaching to the choir for me, and I agree completely. The 3 years is a great number, and that's why I recommend that the business owner starts this process a minimum of 3 years before their desired transition. And that could be merely stepping back from the business. It doesn't have to be the full sale and they're gone. But 3 years in advance, then you have time to get those cleaned up financials, get them as good a shape you can, start to improve the problems that have been identified that would prevent it from being sellable, such as relying too heavily on the owner and a number of other things that would be looked at. And not only that, the 3 year number is very important because we may need to change the legal the entity structure. And this will raise red flags, or it's not, you can't do it if it's less than fewer than 3 years from the exit, or the IRS will scrutinize your client too heavily and it won't work.
I'm so grateful you brought that up. You're right, because there are different ramifications selling, say, a sole proprietorship versus an S corp versus a C corp. I mean, there are ramifications there that we need to consider. Tax things that are actually then going to come into play. So very wise to bring that up at that point, because you don't want to make this change 6 months before the transaction. So very good point. So as it relates to the accounting professional, one of the things that I'd really love your input on is oftentimes when we're looking at the accounting and we bring up to the client that their business is growing, they've got top line revenue growth, we're looking at it from an accrual point of view, a cash point of view. One of the things that the business owner might ask is, well, what's my EBITDA? And that's a way of valuing the business. But can you go over with me what are some of the common ways that you see businesses being valued as they come to determine what their worth is?
Correct. And this is another way the accountants in the audience can really help their clients, because one of the first things after the business owner admits that he needs a plan or she needs a plan is to get a valuation. It
Hmm.
doesn't have to be a formal valuation, but it should be a trusted third party, such as your CPA. And that valuation is then the accountants need to explain and the tax advisors need to explain what would be the net you would take after taxes with that sale. You can't take the sticker price. You have to look at the after-tax sale and then go to the wealth manager and say, with that amount I would get if I sold today after taxes be enough for me and my family to live on for the rest of our lives with our current lifestyle. And that's often an eye opener because the answer is usually no. The answer is usually you're spending too much and your company's not worth enough. And because everybody thinks their baby is worth more.
Everybody thinks their baby's beautiful. So there you go.
They think it's beautiful and very valuable, to mix the metaphors like I like to do. So the valuation is typically done on a multiple of EBITDA. But you can't just use that. It's a nice thumbnail benchmark, but it's of course not super accurate. There are so many other things that go into it, but the size of the company and the industry will greatly affect what that multiple would be. So you could look at 3 times EBITDA if you want to look at a minimum kind of just off the cuff sort of thing, but that's of course going to vary. So the larger the company, the higher will be the multiple in general.
So let's talk about this a little bit, just because I think as accounting professionals, us understanding this will help the conversations we're having with our clients as we're doing their accounting. So you talked about EBITDA. As it relates to coming up with the multiple, you talked about size. So one of the things that's very important is, yes, you've got comps that can come into the valuation, comps of recent sales or transactions that have occurred of similar NAICS code numbers. So all of a sudden you've got comps happening in that industry, but we've got size that comes into play. Do you see that there's thresholds, say, for example, at 5 million or 10 million or say 50 million in revenue that can impact the multiple? In other words, you brought up 3. If I was a $5 million business, is there any value getting to 10 million? Could I actually see that multiple increase if I got to be a 10 million business in revenue?
Spot on, Roger. The thresholds tend to be 5 million. You've gone past that very small business threshold. And then 10 million, if a company is profitable with 10 million in annual revenue, then they've opened up a lot more options for themselves because suddenly they're a lot more attractive to different kinds of buyers.
So one of the things that I want to then understand is that multiple. Is that a multiple on revenue? Is it a multiple on, say, net profit? Is it a multiple on EBITDA? What is that multiple, and what is the more common way of looking at it?
Typically, it's a multiple of EBITDA.
Okay.
Including or seller discretionary earnings for the smaller companies. And that's why it's really important that the accountants help the business owner to start really not just having these clean financials, but also really do the hard work of separating out the personal expenses from the business, because that's boosting that bottom line. And they're going to need to do that anyway to get ready for the sale.
Yeah. Now, I liked earlier you were talking about the team of individuals. You've got the lawyer, you've got the financial manager, you've got the accounting professional, you've got the business broker, perhaps. All these individuals are meant to help that business owner get the most out of the company that they have. But one of the things that's interesting is oftentimes in that transition, it's not just a simple purchase or buyout where the owner is just given a lump of sum and they walk away. Oftentimes there's a buyout period, there's a transition period. You were talking about transition. What do you see as common as business owners may be asked to stick around for a year or so and actually in that perform, and it's from that performance actually get a portion of that valuation that was now held out just because of the fact that we wanted to see how the company does perform based on projections? What would you say to all of that?
Yeah, very true. An earnout it's called an earnout. It's quite common. And it should be very heavily negotiated and scrutinized by the seller's lawyer, because I've seen sellers really get in trouble and face huge disappointments when they don't get their earnout. They can even be worded in a way that says you have to hit this amount of sales or profit to get the rest of sometimes up to a third of the sale price.
Correct.
After that threshold is met. But if they don't meet 100% of the threshold, I've seen that they get 0 earnout. It's not it's not a weighted average of that or percent of that. So that I've seen some really bad scenarios if you don't get good advice early on. But it can be a nice thing because every owner should stick around for a while after the transition. A common amount of time might be 6 weeks or 3 months. The seller should be expected to stick around and help the new owners, learn the business. But that should be a compensated period of consulting or however that's structured. And then anything after 3 months may be part of the earnout, and it could be a year, it could be years and years, but it's to be approached with great caution.
I like how you're doing some good cautionary tales there, because one of the things that can happen is it can be a negative experience. I've known of a number of stories where the earnout is a rough period of time. It's not that these people are customary to working for someone. And so sometimes the numbers don't hit the forecast that were used as part of the valuation. So yeah, a lot of variables there. So one thing that just to help my listeners understand is, and maybe I'm making this too easy, but that's the point. Let's assume that the buyout or the sell price was $1 million and the person was going to be given, let's say, half of that upfront as part of the transaction. Well, that 50% of the valuation is going to be earned out over time. And let's assume that it was going to be an earnout over the following year. And in the course of that year, certain metrics need to be made. If they're not met, then they're going to forfeit a portion of that $500,000 that's remaining as part of that buyout. Well, the thing that's interesting is, obviously, we were very optimistic about what we were projecting to happen. If we miss those numbers, it's going to impact that $500,000 that remains to be paid. But the thing I wanted to bring up with this, just because you mentioned this, and I think this is important to realize, is in that transition, it could be that you realize 6 months into this 12-month agreement that it's not working out and there's just not a healthy relationship and you just want to walk. Well, you should build into it legally basically an out where the remaining $500,000, even though you're not going to remain the 12 months, can still be earned or given at a discount so as to not forfeit the entire amount. So it's just basically having a great lawyer that's part of the transaction that's building in these contingencies so as to ensure that you're taken care of as the seller.
The turnkey marketing and sales process to getting accounting clients with confidence. The Universal CRM is in fact a tool designed for accounting professionals to help them automate the process to the point of not only finding potentially new clients, but having meetings and getting new engagements to retain them as clients. This process is made up of using specific tools such as CRMs, email marketing, text messaging, sales pipelines, forms and funnels, as well as reputation management and social proof, getting the testimonials that you need online to substantiate your skills and services. All of these tools and technologies are leveraged to your benefit using the Universal CRM. Go to the episode description and there get the information you need to take advantage of this today.
Now, I want to back up here because, Nancy, one of the things that I really appreciate about what you do as a service is you help businesses prepare for that exit. From an accounting point of view, what are some of the things that we can, as accounting professionals, do to help the business owner get the largest valuation that they can?
Oh, there's so many things that can be done, and it's really particular to the situation. As an accounting professional, it's really since you're trusted by your client, one of the most important things you can do is bring up the topic.
Mm-hmm. Yeah.
They might not bring it up to you. So really, I look at all of this. Yes, the numbers are important. And yes, of course, there's financial aspects to this. But this is a very human situation and it's very emotional. And so I always caution to not just look at numbers. Just don't think of it as a transaction. It truly is a transition. It's a life-changing transition. It's the biggest event, one of the biggest events of the business owner's life. It can feel very painful. It's an emotional roller coaster. So if you, the accounting professional, as their trusted advisor already, broach the subject as soon as you can, hey, what are you going to do if you decide you don't want to work anymore? Have you thought about who you want to take over your company? Do you know what your company is worth? And do you know what you need to live on? Questions like that, slowly getting them used to having these conversations is probably the biggest thing that they can do in the beginning, besides everything you mentioned about keeping the financials clean and ideally audited and up to date, and then helping the bottom line to be as strong as it can.
Well, one of the things I would add, and I appreciate you bringing up the emotional side of this, is with regards to the whole accounting perspective is I just provide as part of our accounting numbers, EBITDA is just one of the things that they're reported on a regular
Yes,
basis. And they will ask, what is this number I keep looking at or seeing?
right.
I mean, EBITDA, this acronym, what does it stand for? And just that natural conversation of, oh, this is what your company is worth. It's one way of valuing your business. It's not looking at your assets. It's not, doing these other things. It's just basically one of many ways to determine a valuation of a company. And they're like, oh, okay. And it just starts, I think, that conversation that you're alluding to that we just need to naturally be having. And it will eventually turn into, oh, yeah, I have plans of retiring in 5 years. Oh, yeah, somebody recently offered me something for the business and I didn't know what I really should expect, or, was it a good offer at all? All of this comes from you starting the conversation by just providing the numbers and opening the door for the conversation.
Yes, thank you for mentioning that.
Yeah. Now, one of the things that I want to get into is the emotional side that you mentioned a moment ago. I think for a lot of people, they don't realize the emotional roller coaster that selling the business can be. And as accounting professionals owning our own companies, we're going to go through this at some point. As we work with our clients, we may experience their transitioning through this because they sell the business, and we're going to take this good relationship that we have and witness them go through this evolution. So I'm going to go back to my analogy I gave a moment ago. I do see it as a daughter. It's someone that I've raised. I've seen, I birthed the company in the sense that I was there when it started. I'm helping it go through this phase of being independent, but I have to feed it. I have to nurture it. I've got to be there to open the door. I've got to address it and take care of it. As it becomes a little bit more mature as a teenager phase, it's able to do things independently. I've got good key employees. I've got management going in place that have decisions and direction that they're running with. So I'm not having to be involved in every decision. It can have other interests other than what I'm familiar with, simply because of the fact that the company is growing and we're taking care of our customers. But eventually it's going to get to the point where it wants to go off on its own. And maybe I'm not that leader I once was. I'm not that one driving everything. Maybe I'm not as astute as I was 20 years ago when the company first started. And there might be better people to run the company moving forward. And it's like having that daughter that goes off to school or perhaps gets married. It's a bittersweet moment where they move out of the house. They step out on their own, they become independent, and you hope that you taught them correct principles that they can now govern themselves properly, but you don't know. And so as a business owner, you let go and you see this business take off on its own. And all of a sudden it's in a situation where you don't have any influence or control per se. The company is on its own. So what do? You're no longer raising this child. It's a grown adult. It's doing its own thing. And there's that anxiety, that separation anxiety that steps in of what's my identity? Who am I? It's that empty nester syndrome of you look around the house and you're like, okay, is this what it's supposed to be now? How do you prepare a business owner for that mental transition of letting go of the company?
Yeah, and that it is too often overlooked, and
Mm-hmm.
that will derail a deal more than any other thing. And it's disguised as, oh, wait, never mind, I need more money. So it's disguised because especially the male business owners have a really hard time acknowledging or identifying the emotions that they're going through. So they look at it in more practical terms
Mm-hmm.
when that's not really the issue. So it's very important to have the trusted advisors be cognizant of the emotional aspects, and for the transition to be slow and gradual, and for the business owner to maintain control. So what I ask of my clients to really think about: what is your ideal date that you're not working full time anymore? Who is the ideal type of person you'd like to take over your company? What would you like to do when you're not working every day? So, golf is not a long-term plan. So they need to really think about what charities do they want to become involved with, new business they want to start. They really need to have something to occupy themselves instead of just sitting at home all day or being on the golf course, because that leads to regret. So helping them think through and, take a week off, start by taking a week off. Some people don't even do that. Take a week off and then start to take a month off. And so that's like you're saying, the child is starting to function on their own. That's getting the business ready to function without you, but getting you ready to function without your business, which is just as important because of that emotional roller coaster. And then there are actually deal psychologists that are available and that are pretty much in demand because, in that last year, when the company finally goes to market and the process, the due diligence is happening, that's when the roller coaster gets very intense because there's the deal fatigue sets in, there's problems that come.
Oh, yeah.
It's overwhelming for a business owner that's never been through this before, especially. And they need a lot of support.
Yeah, one of the things that I've experienced is business owners, we're a very driven bunch. At that entrepreneurial spirit, it's hard to understand, but at the same time, it's hard to let go of because you have purpose, you're driven. And when you have these individuals that are very much focused on something for so long, it's hard to all of a sudden let go and be aimless without purpose. What do I get up for in the morning? What am I doing next? And it's not uncommon to find that after 6 months of golfing, watching movies, reading books, they start to wonder, who am I and what am I supposed to be doing? And they start finding that they're waking up at 11 o'clock in the morning and they're still in their pajamas at 2 o'clock. And they're like, what's going on? This is just ridiculous. So you've got to have that purpose of, okay, you're selling the business. What's going to be next? And if you can take their attention and put it on that next chapter in their life, it gets them something to be excited about, gives them purpose again. And that's one of the things that I think too often is lacking, because that payout, that check can only be so rewarding, and it will phase in time because you still have your identity that you need to be considering of or considerate of. So now I want to focus on some stories. Do you have some success stories that we can maybe bring to the equation to show, especially how accounting professionals might have helped in getting a great transition?
I do. And my stories revolve around the central message that I would like everyone to understand, which is this is not a binary sell, don't sell world.
Mm-hmm.
It's not a house. So even if we can liken it to a house in a number of ways, for example, side note before I answer your question, I was introduced at an event last summer, and a guy said, "Hey, I live in this nice part of Houston, and my left side and my right side of my house, they both went for sale, up for sale at the same time. My house on my left, they'd been preparing for 3 years. They'd upgraded everything, a state-of-the-art kitchen, blah, 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 landscaping, and the other house just put up the shingle one day. 3 months later, the house to the right is still languishing there with no offers, and the house to the left had sold immediately. So that's a good way to look at a business, that it needs a lot of preparation and window dressing to be attractive. But the point is that there are many other things that an owner can do besides just sell their company. So some of the examples that I have revolve around these really interesting nuances to this world that I find so fascinating. So, for example, an electronic medical forms company that we were working with, they originally thought they would be happy with an $8 million sale price.
Okay.
And what I think is interesting is that almost every business owner has a number in their head.
Yeah.
Either they think this is what my company's worth based on actually no reality, and they have a number that they want to sell for based on some deep, something deep in their psyche that they probably couldn't even explain.
Yeah.
And so they came to us, and they realized that they were not going to have that. Their company was not worth that. They weren't going to achieve that number in any way in the foreseeable future without some major changes. So we help them to change their business model to a software as a service, which has the recurring revenue. And I'm sure all of your audience understands that recurring revenue is valued a lot higher than one-off revenue. So it's always advisable to help your clients look for recurring revenue part of your business model.
Oh, yes.
And we built in a retention plan for 11 of the key people. And this comes back to the human aspect of business, which is, if it's just, some numbers on paper, those numbers can't be continued without the key employees staying. And a lot of times people will leave when they start to hear the changes underfoot, or they're fed up with the old owners because their foot's been out the door for a couple of years. So they think the company's dying, and they leave. So we want to really build in some retention plans to give incentives to the people to stay that you need. And then the most important employee, we gave them an incentive to actually raise the value of the company. So they were given two types of incentives: to stay and to raise the value of the company. And so then we put 50% of the after debt value of the company into 3 different charitable trusts.
Okay.
And in the end, 5 years later, so it was a long engagement where a number of changes had to take place. But in the end, they got an offer by a strategic buyer for $43 million. So a strategic buyer versus a financial buyer, for the few people in the audience that might not know what that is, even though I don't want to insult the knowledgeable ones in the audience.
No, let's tell them.
Buyer would only look at the multiples. So if your industry and your company size says, it looks like the comps are showing 5x EBITDA is my value, that number is going to be dwarfed by a strategic buyer. And a strategic buyer is likely in your industry or wanting to vertically integrate. And so having that company fits their strategic plan, and so it raises the value significantly in their mind. They're going to blow past the traditional EBITDA that a financial buyer would not go above for any reason. And a private foundation was originally considered for these owners, but they were shown that the foundation was not really the best choice and that the trust was best due to certain liability issues.
Get your free copy of the book In the Black, 9 Principles to Make Your Business Profitable. This is a how-to guide for accounting professionals to work with their clients and actually implement proven processes and systems to ensure that their clients make profit a priority. It is in this book you'll actually learn how to map the business and, in fact, make marketing, accounting, and production a priority within your client's business. You also learn the wisdom pyramid, how to actually take the information you're providing to your clients and effectively use it so that they can make more informed business decisions. This book is designed to help you communicate more effectively with your clients and, in fact, have them see you as their profit and growth expert. Get your free copy now of the ebook today, In the Black, 9 Principles to Make Your Business Profitable.
Another example that I really like is one of a vending machine company. They had coffee vending in different companies.
Okay.
And they had, if I have time for another story.
Oh, yeah, go, please.
Okay. And so there was 2 owners, Roger, and we call them by their ages at the time that they engaged with us. And one was 49 and one was 51. And they said, we have a plan. And this is really typical when people think they have an exit plan. It's something in their own head, more like a wish than a well thought out plan, because they don't know any better. So the plan was that 49 was going to buy out 51. They were going to get to 10 million in value, and 49 was going to give 51 $5 million, and 51 was going to sail off into the sunset, and 49 would own the company completely and keep running it because he loved to run the company. And there was a number of problems with this plan. And first of all, the company was nowhere near worth that.
Okay.
Second big problem is 51, with his lifestyle, could not have lived on the $5 million to save his soul. It was not going to be enough. And the third big problem, which I love to tell this example to financial professionals because some light bulbs start to go off. Where's that $5 million coming from? So it's really nice. Like up to there, the plan is like, okay, we can get you there with some time. We can increase the value of the company and get 51 the value that he needs and help him with the wealth management and trust and all that. Like those 2 problems were solvable. But the thorny one was, where's the money coming from? So if 49 were to borrow the money, then of course his borrowing capacity for growing the company is tied up. He's tied up his, if he can even borrow it. If he wants to pay it out gradually over the cash flow of the company, it's the same thing. And you're often in a double taxation event in that case, because you've got the earnings of the company and then you're paying them out. And then the recipient is also paying the taxes on that. And so it's just really problematic from a taxation. The company has to earn so much more money to be able to pay that $5 million out. And then the fourth problem with that is, why is that fair? Why does 51 get to sail off into the sunset with a suitcase full of money and have no responsibility or problems and get that? And then 49 is stuck to struggle, has a higher tax bracket now because they're now earning all of the profits of the company. So their tax bracket has increased and they have all the headaches, all the responsibility, plus they've just paid their valuable partner to walk away. So I think that example is a really good way to look at all the problems that can go wrong with a poorly thought out plan or a plan that isn't really a plan. And so what we did was we convinced them, first of all, it took a while to convince them of all those problems, and then show them that a better option is to bring in a third-party investor, which is a solution I love to get people to think about as their it's not sell or don't sell. What about a minority recapitalization? Bring in an investor that knows how to grow the company, that has cash. They both sold 25% of the company to this third-party investor. 49 stayed and ran the company. 51 left and became a passive owner of a new entity that was formed. Then this investor grew the company significantly. And so they both cashed out a little bit in the beginning to sell that minority stake to the investor. And then 8 years later, they both sold again, that second bite of the apple. And instead of 51 getting 5 million, his share was worth like 35 million. And he still didn't have to do anything. He was a passive owner that stepped aside so that the investors could take over and his younger, energetic partner could still run the company.
Younger by 2 years, 3 years. There you go.
Yes, but he had more energy. He wanted to stay and the other one didn't want to stay.
Yeah. Well, the thing I like about that example is the fact that it isn't just a cut and dry, you sell or don't sell. The fact that they were able to actually liquidate 25% of their equity, and in doing so, actually get another investor in. Now you've got somebody with fresh perspective and energy coming in and furthering the business growth. And all of a sudden, the remaining equity that those business owners held, like you said, grows, and they get a second bite of that same apple. And I think that's a great illustration of some wonderful planning, if you will, with a good strategic team giving advice as to how this isn't the best decision that you're looking at initially, and we were able to improve upon it. Those stories, I think, are examples of, as accounting professionals, what we should expect to see with our clients, what it is that we can anticipate they will go through, and how we might be able to better prepare them. And as accounting professionals, one of the things that I think is very important to bring up here is the fact that so many of us are having these types of conversations. And this is a great introduction into the idea of offering CFO and advisory type services that really can actually start addressing the business model, what they can do to increase the valuation of the company, and most importantly, prepare that business owner for that mindset that they need to have in order to sell or exit from the business. So I like what we've been discussing here today. Nancy, what I'm going to do is I'm going to go ahead and wrap this up. One of the things that I'd like to share with my listeners is in the episode description, you're going to find that Nancy has a wonderful offer. She has a discount of $500 off the first 5 people that sign up for the profit driver analysis. This is a way of actually assessing your business and also that of your clients. And so if this is something you'd like to bring to their attention, be that person that offers them something that they can save some money on and get some great information, I would encourage you to take advantage of this. Go to the episode description and you can uncover the profitability leaks and get highly accurate, actionable insights that reveal your true profitability potential in just 12 drivers. These are things that you need to consider as you're running your business. In addition, what I'd like to do is encourage you to go to universalaccounting.com and there find the free resources. You're going to find information there as it relates to what it is you can be doing to prepare for selling your business and that transition that we've been talking about today, as well as get some additional reports and assessments on what your business is actually doing and worth today. So check out that information, go to the episode description and find those things now. In addition, I also want to mention that Universal Accounting Center, sponsoring the show today, has a program called the Profit and Growth Expert. It is actually a course designed to help individuals offer CFO and advisory services, where it covers the pricing, the marketing, selling, the onboarding, and fulfillment of CFO advisory services. So if you'd like to actually begin working with your clients in a more of an advisory capacity and be paid accordingly, check out what it is you can do today to complement your accounting services as a profit and growth expert. Now, with all that being said, one of the things that I want to do is, as a summary of our conversation today, point out that I think what we've discussed is hugely important. I started with the idea of beginning with the end in mind, and that's exactly what we're talking about here. Businesses have value, and when we're working with our own or that of our clients, we've got to recognize that what we're doing actually has impact. And so Nancy did a great job of explaining that there are these transition points, things that we need to consider as we're running a business. And one of the things that I think was really important is she invited us as accounting professionals to bring up the conversation of EBITDA and those other things that relate to the valuation of the business to help the business owner understand that we can be part of that valuable team that they need to create and prepare so as to be ready to actually sell the business. And as an accounting professional, align with that business broker, that lawyer, that financial management person, so as to ensure that the business owner is best taken care of. We also spoke of in our conversation today, the idea of doing this with premeditation, the idea of 3 years or more preparation. It's not just something that you immediately want to bring up and walk into. She also pointed out that there are these very distinctive characteristics or circumstances that may arise that could cause an accelerated exit. Some of the things might be death, divorce, disease. She was very good to point out that those things oftentimes come unannounced, and we need to be prepared in our business to actually take on those situations with our business functioning properly. I was able to share that as a metaphor. It's great to actually look at the business as a child, evolving and growing from a childlike state to a teenager and then a young adult, that there are an emotional type interaction as it relates to our business and how we look at our involvement on a day-to-day basis. So lots of great little insights and takeaways, and clearly the opportunity to take advantage of this offering to get your business analysis with the profit drivers. Now, one of the things that I'd like to do is with this, ask you, Nancy, what would you like to leave as a parting thought?
Thank you, Roger. My parting thought is that every business owner needs to understand that they have options, and they have many more options than they are currently aware of, hands down. There are 8 traditional exit paths that they can consider, multiple pros and cons associated with each exit path that they have, and they need to get a trusted advisor that understands those paths to advise them on what is the best path they should choose for their individual situation, and to start at least 3 years in advance, and then they can choose to exit when they want for the amount of money that they need to survive on and to the person or company that they choose.
I like that. Very well said. Well, Nancy, it has been a pleasure. I've enjoyed having you on the show. I love this conversation. I think as accounting professionals, it is something that we need to be bringing up with our clients. Their business is an asset. They need to see it as such. They're building on it. They're working on it. And what we need to do is be able to show in some way what it is actually that they have built. So one of the things that I want to do here is just stress the importance of this conversation with our clients and encourage you each to have that. Now, having listened to the show, I want to encourage those of you who have not subscribed to the podcast. We'd love to have you as a regular listener. You want to set your notifications because each and every week we come out with new episodes to highlight those things that we need to be doing to offer quality accounting services and take care of our clients. Now, in relation to this, one of the things that I want to encourage you to take advantage of is you can actually go to universalaccounting.com and find in the navigation the podcast section. It's there that we've actually put together highlights. These are playlists that are essentially designed to focus on specific parts of your business, whether it's marketing, selling, mental health, training staff, and so forth, that you could be doing to actually binge listen and work on your business. And I invite you to take advantage of that. Find those things that are typical and most importantly, topical to your situation and dive into those today. In addition to this, I want to invite you to GrowCon. GrowCon is an annual conference for owners of bookkeeping, accounting, and tax businesses. It's an event you do not want to miss. It's here where we bring to the stage the experts, individuals we need to be hearing from. It's where we learn those things that are topical, allowing us to work on our business. In addition, you're going to meet your peers, make friendships, collaborate, find out what it is that you can be doing to work on your business from those who are doing exactly like you. Lastly, you also get to meet my staff, those individuals here at Universal Accounting Center who are committed to helping you be in business for yourself, but not by yourself with Universal Accounting. So all those things being said, join us for GrowCon. If you haven't already, register, get your tickets today to join us for GrowCon. Go to universalaccounting.com, and in the navigation, you'll find the information regarding the event, and I look forward to seeing you there. Lastly, as it relates to this topic and so many more, if you'd like more information regarding the programs that we have to assist you in offering quality accounting services and becoming the premier accounting firm, check it out by going to universalaccountingschool.com or give us a phone call. You can reach us at 801-265-3777. And always remember this, accounting success is universal. Take care, have a great day, and be safe out there.